Joe Terranova, you tell me first, what's going to be the determining factor this month for stocks?
Well, Scott, I think we're going to need to see some performance, not just from growth, which significantly outperformed value, as you know, by 500 basis points in the past month. We are going to finally have to see energy and financials come around. And I know I am asking for a lot to see those sectors participate. But to your comments at the top of the show about the month of August and the impact that it has, went back and we studied the last 10 years. And in the last 10 years, if you did go and purchase or enter the market at the low point in August, at the end of the year, in each instance except 2018, you were rewarded for that. So I would actually be concerned if we don't see a correction, because that's exactly the setup in 2018. We never got the August correction, and we set ourselves up for a really bad fall. So I'd like to see a little bit of a correction. I would also like to see financials and value and energy participate here. I think that's going to be important. But any type of correction, the history of the last decade tells you that's an opportunity to be a buyer thinking forward over the next 3 to 6 months.
Steph, you agree with Joe? Do we need to see a value trade that works, even if it's financial, some of the other sectors, or if big tech continues its run, is that enough to carry the load again?
Well, big tech is 26% of the S&P 500. It's the largest sector by far. If you have look at energy and financials and industrials, that most is about 18% of the S&P 500. So, yeah, I'd like to see the participation because you know I have exposure there. But I think it's going to be economic data that drives this market. Vaccine progress, that's going to be very, very key. And then you're also going to deal with macro just in general around the world. Today I was pretty encouraged that we actually got decent PMIs around the world. We had an okay one. We had a better ISM with new orders up 5 points, which is huge. But I was also very encouraged about the M&A we're hearing about. This started with Warren Buffett 3 weeks ago when he bought the pipeline of Dominion Resources. And then it was also Uber with Postmates. And now you had today Varian. I know everyone's talking about Microsoft. I think Varian is huge with Siemens. It's the largest healthcare deal so far this year. And what that tells me is that CEOs are feeling a little bit more confident. Maybe not 100%. Maybe they're still worried about a lot of things. We all are. But they wouldn't be putting their money where their mouth is and making big acquisitions that they didn't see good values and opportunities. So I'm encouraged, actually, by today.
So we get back to economic data actually mattering and as to where the stock market goes, right? Because, I mean, yeah, the last month's jobs number was fine. We get that. But by and large, the economy is still struggling. The market hasn't cared, right? The market has been able to brush that off because of expected stimulus from Washington and, of course, the big kahuna, the Fed.
Well, no, I mean, jobs is the real downer of the environment right now. There is no question about it. But we've talked about there are pockets of actually economic data that's coming in, both macro and micro, like housing and like auto, like e-commerce, retail sales. So there are still some pockets of the economy that are doing well, even in the face of bad job data. And I don't think Friday's number is going to be good by any means. It could actually be a lot worse than expected. And I am watching initial claims. We talked about that last week. I'm going to look at the 4-week moving average to determine whether or not I push out my recovery mode. But I do think economic data is important. And if we, to the degree that we actually see an improvement in some of these other areas, I think that will help pick up the slack for the job disappointment.
Megan, why are you underweight stocks still?
Well, Scott, for a lot of the reasons that you're mentioning, the economic data is very much in question right now. We've had a nice bounce off of the bottom in terms of labor market data, retail sales. But at this point, so much of it depends on congressional stimulus, which is still very much an open question. And a lot of the real-time data that we're looking at is pointing to, at best, a slowing or a plateauing of economic data, in some cases even a rolling over. So that's the big story for us. Earnings season is a reminder that the market is not identical to the economy, but at some point, to get that broadening leadership, we do need to see small business, the labor market, all of these things picking back up. And we think that we're in for a choppy ride over the near term.
So we get back to a connect, if you will, between the market performance and the economy, which has been largely disconnected. At some point, you're arguing, Megan, it has to matter. And you think as we get further down the road into the calendar year and closer to 2021, you're going to have to start to see some results?
Absolutely, yes. I mean, we have the congressional stimulus package that's being debated right now, and that has been a huge lift for the low-income consumers. And a lot of what we've seen from whether it's Apple's sales or autos, as Stephanie mentions, a lot of that is dependent on stimulus. So I'm uncomfortable with a market that is pricing in so much optimism and yet is reliant on policy at the underpinnings. Longer term, I would say any correction you want to be thinking about adding, but in the near term, for those clients who are, for those of our clients who have cash on the sidelines, we're preaching patience and putting that new money to work.